Hey guys, and welcome to another episode. Smart money concepts offer many advantages over other trading styles. By providing clear criteria for chart analysis, it makes it easy to understand any price chart and execute high risk-to-reward ratio opportunities without feeling pressured. In this video, we will first explain the basic smart money concepts that you need to apply on the chart before making any trades. This includes identifying market direction, understanding market structure, finding the best supply and demand areas for trading, and recognizing liquidity zones. Also, we will provide a step-by-step explanation of the top smart money trading models that every trader should know. So guys, if this is something that interests you, make sure to hit the like button to show your support and subscribe to our channel if you're new, since we publish many advanced trading concepts. Let's start with the basic concepts and fundamentals. Identifying the market direction. Supply or demand. Who is in control? Identifying the market direction is generally the first step in analyzing a price chart. We want to identify the trend and determine if the buyers or sellers are in control. We always aim to trade aligned with the controlling side of the market. How does the system work? The system operates on mitigations. When the price mitigates a demand level, demand takes control over supply. Conversely, when the price mitigates a supply zone, supply takes control over demand. Imagine the price is moving in an uptrend, creating a series of higher highs and higher lows. Each time the price breaks the structure to the upside with inefficiency, a demand zone is formed. These demand zones remain unmitigated until the price taps into them, offering a perfect opportunity to follow the dominant trend. However, if the price breaks below a valid demand area, this is called a change of character, indicating two things. First, supply has taken control over demand. Second, a valid supply area has been established. The price then continues to move downward, forming supply areas until it reaches the next unmitigated demand area. At this point, there is a battle between supply and demand. Sometimes we see a period of consolidation and a ranging market between these two zones. Breaking either zone indicates who takes control. Here we have 1, 2, and 3 moves that break above the previous market structure, indicating that demand is in control. We have an unmitigated demand area which will act as support when the price returns to this level. Once more, we have a temporary correction, and the price breaks the high with imbalance, creating a strong demand area again. Still, the market sentiment is bullish as long as the price trades above the extreme demand. Now we can see that the market has tested the demand level and failed to create a new higher high due to a lack of buyers' strength. After breaking below the low point, we can conclude that the buyers are no longer in control and we might witness a reversal. If we consider this point as the start of the impulsive move that caused the market structure shift, here would be our supply area. Continuously, the market breaks the structures to the downside, showing that the supply is in control, creating multiple supply areas. Each of these supply areas could be a potential selling opportunity until we reach this unmitigated demand area in front of the price. This zone can be a potential interest area for the buyers to step into the market. So, at this point, we have a battle between the buyers and sellers. Therefore, we must wait and observe the further price action to determine the market direction, because this level can be a turning point for the price, or we might at least witness a temporary correction. Now, here is an important point. We cannot control the market. However, we can prepare ourselves for the different scenarios that might happen. Let's move on to the next topic: smart money market structure. The market structure holds essential information, market direction, key supply and demand areas, liquidity zones, and potential trading opportunities. Let me show you some basic concepts about the smart money market structure. In an ideal uptrend, the market continuously makes higher highs and higher lows. Every time market breaks a structure to the upside with imbalance, a demand level is automatically created. The imbalance between the buyers and sellers are identified through witnessing the fair value gaps in price action. The demand levels that created FVG are super important and consist main part of chart analysis and smart money concepts. As long as we stay above this zone, the demand is in control, and the market sentiment is bullish. But if we get a break and close below this level, we call that a change of character that signals a possible reversal. With all being said, the levels that created the fair value gaps and break of structures consist our major market structure levels, and reacting to them convey lots of information. The same concept applies to the bearish scenario. Keep in mind that the market structure and liquidity zones are two inseparable concepts in smart money concepts. Many liquidity areas find meaning through market structure, and many market structure levels become meaningless with liquidity concepts. Liquidity areas are where retail traders get involved in the market. We know that multiple rejections are interesting entry levels for traditional traders, so there are many stop losses, and liquidities are gathered below them. Smart money aims to sweep all of the retail traders' stop losses, and we want to enter the trade after stop losses have been swept. Now let us show you some of the most powerful models which combines the market structure and liquidity on the chart. The first model is a basic liquidity sweep through a major market structure level. Here, on the gold 30-minute chart, we have a clear uptrend. We have a recent level of support which has been rejected by the market multiple times. When the price approaches this level, price action traders will go long anticipating a rejection from this key zone. On the other hand, traders who previously entered long position will support their positions. So, this area is considered a key liquidity level, and stop loss are gathered somewhere below this area. Now the question is, where can be a point of interest as smart money trader? If we look to the left-hand side, we can notice this area of a fair value gap which is an extreme demand zone. This is our point of interest, and we can look for buying opportunities. So as a smart money trader, we want to get involved in the market after the stop losses have been swept. A perfect combination of market structure and liquidity concepts on the chart. Now let's see the second liquidity model. Here we have a valid order block and a potential trading opportunity to go long. But looking at the left side, we can spot this gap between the candles, precisely below the first order block, and another valid order block zone here. Now this gap will act as a magnet for the price to come and fill it, restore the balance, grab the liquidity below the first order block, and continue pushing upwards when it mitigates the second one. So here are 2 points. First, before placing any trades, you should look at the left side to see what you have to avoid this kind of unnecessary risk. Second, when this pattern is formed, and we have a gap and another valid order block precisely under the first one, we don't consider this break a valid change of character, since there is a high for this move to be just a liquidity grab and does not necessarily mean a reversal is coming. Now that we have discussed the fundamentals required for general chart analysis and how to identify the market direction, key levels, and potential trading opportunities, let me explain 3 of the best smart money trading setups step by step with all the rules. Let's start with the basic order block entry. Order blocks are optimized supply and demand areas. They form whenever we have sharp moves with imbalance, breaking the previous market structure. Usually, we mark the last candle that created the fair value gap as an order block, which we believe that the decisions are made during this candle. The order block trading setup is very simple and effective. In this setup, we use a basic order block entry when it is aligned with certain market conditions. In the first step, we look for a valid and fresh order block that the market has recently created. A valid order block must have obvious inefficiency and fair value gaps between the wicks breaking the market structure. Then we simply place a buying order a spread size above the order block zone and place our stop below the swing low. We will close half of our position when the prices reach 2 times our risk. This way, even if the price drops and hits our stop loss, we are at break even. For the second target, we will aim for the next key level in front of the price. To make this strategy more effective and profitable, consider the following key points. Trade with the market direction. This strategy works best as a trend continuation setup. Always trade when the market direction is clear and the controlling side is identified. Trading with the dominant trend increases your chances of success and reduce the risk of getting trapped on the wrong side. Check higher time frame key levels. Before trading, assess the higher time frame key levels and how much room the price has before reaching them. A small reaction at a higher time frame key level can indicate a major direction change in lower time frames. When the price mitigates a higher time frame key level, there is a higher chance of a temporary reversal. Always verify the higher time frames to gauge the distance to key levels. Analyze the left side of the structure. Before placing any trades, examine the left side of the structure to avoid low-quality trades. For instance, if the order block is positioned in a liquidity zone, or if there are gaps and another order block just below, the risk of a liquidity grab increases. The second trading strategy is an order block entry pattern accompanied by a liquidity sweep. Imagine we are in an uptrend, and the latest move breaks the market structure to the upside but has no inefficiency. On the left side, we notice inefficiency just below the swing low and a valid order block zone. In this scenario, there is a higher chance for the price to break below the swing low, grab the liquidity, and continue pushing up when it taps into the order block demand area. When this pattern forms, we place our buy order a spread size above the order block zone and target the next level in front of the price. Our stop will be below the swing low, with the entry based on combining order blocks and a liquidity sweep below a minor demand area. The same concept is applied to the bearish scenario. The third trading setup is called the order block in order block trading strategy. We use 2 time frames to execute our trades based on this setup. In the first step, we analyze the market direction and structure, then mark our higher time frame order block zone. Next, we wait for the price to return to the order block, zoom into lower time frames, and look for a change of character formation to confirm our entry. If there is no change of character, we do not trade. The change of character indicates that the short-term downtrend is over, and the market may start moving to the upside. There are 2 common scenarios for entering trades. Change of character with inefficiency and order block. When the change of character is accompanied by inefficiency and creates another order block, we place our buy limit a spread size above the order block and set our stop below the swing low. In this setup, we track our profit by repositioning our stop below the higher low every time the market breaks a structure to the upside. This technique allows us to maximize profits if the market moves in our predicted direction without any pressure. Change of character without inefficiency or order block. When the change of character creates no inefficiency and no order block, we use Fibonacci retracement levels to enter the market. We apply the retracement tool from the start to the end of the change of character move and place our buy position between the 61.8% and 78.6% retracement levels. This trading strategy is not limited to any specific timeframes. However, your entry timeframe should be at least 2 times lower than your higher timeframe. So guys, that is it for this video. I hope this video had some value for you. If it had, please smash the like button for me and subscribe to our channel if you're new. See you guys in the next episodes.